Hi, my name is Abigail Salisbury, and I'm an attorney. I'm a solo practitioner attorney at my own practice in Wilkinsburg, Pennsylvania. And I was asked to talk about a few legal issues that come up with nonprofit organizations and what causes people to be tripped up, essentially. So I made a list actually of the few things that I see over and over and over again. It does tend to be people are making the same mistakes quite a lot. And so the first one that I see all the time is someone comes in to see me and the organization itself is not set up correctly. And what I mean when I say that it's not set up correctly is that they either just started doing some sort of a program and said that it was a nonprofit. That's the worst offender. Or they, sort of filled out some forms themselves, didn't really do it correctly, or sometimes even the organization lost its nonprofit status and no one paid attention. If you don't fill out your 990 3 years in a row, your organization will lose its C3 status. So that does happen from time to time. And the way that that's usually identified, if it's someone who knew that it was a problem before they came to see me, is that they spoke to someone who was trying to give them a donation, tried to give money, and found out it was not tax deductible because they were not actually a C3, or they applied for a grant or something and found out that it was not deductible because they're not really set up properly as a C3. So the next thing that I see a lot is that their board is not functional. This might seem like it's more of a formation type of issue and not a legal issue, but if you have a non-functioning board that is providing no oversight and no governance of any kind, you are actually in violation of laws. If you don't have a treasurer, for instance, that's a legal issue. And so I see people who, their board meets maybe once a year. I really love for a volunteer working board to be meeting at least once a month, especially if you have an organization that's a fledgling organization, is just getting started. You really need to be meeting on a regular basis. I understand that it's impractical in many situations for people to be always getting together. In Pennsylvania, it is legal to have board meetings using some sort of telecommunications technology. So they've left that vague because technology is always evolving. So for instance, if you want to use Skype, Google Hangouts, just regular old conference call, that's all fine. And you can run your board meeting that way just as you could in person. So if you have an issue where people can't seem to get together, then that's one way of getting around that. I have people who do not keep any minutes for their boards. They'll come in to talk to me about their organization. I find out as I sort of do this, checklist in my head that I go through, that they don't keep any minutes for their board. That's a problem. You need to be record keeping. You're protecting yourself because if you see something going on that's wrong and you say that you are opposing it in the board meeting, but you don't actually have that recorded anywhere, then you haven't really protected yourself. There should be actual votes on issues. People don't always understand that the board should not just be rubber stamping whatever it is that the executive director wants to do. This can be very difficult for the kind of organization that runs in what I sometimes see called a cult of personality. There's a founder, and that founder is basically just given free rein to do what they want, and the board just approves of whatever it is that they request. Issue number 3 that I see a lot is commingling of funds or people who have conflict of interest troubles. So this might be associated with paying expenses for insiders or funneling some sort of benefit to people associated with the organization, whether it's board members, employees, family or friends of the board members, their businesses. You're basically running the organization not for the public benefit, but for the benefit of people who are insiders to the organization. And that is not only problematic for the organization, it's in many cases illegal. So you're going to want to be very careful to make sure that your organization does an annual conflict of interest check. You should have people disclosing where they work, who they're married to, particularly, if people don't have the same last names, you might not be able to tell that Jane Schmo on your board is married to John Q, who has a contract with the organization. So you want to make sure that you have all of that disclosed. A conflict of interest is not a deal breaker. It just needs to be disclosed and dealt with appropriately. And in some cases, you do want to avoid them at all. I do tell people to think about not just how you do things, but how it looks, because in many cases, the appearance of impropriety can be worse than the actual deed of what you undertook. So just make sure that you're running a public charity is what it's called. So make sure that you're running it for the benefit of the public and not just for people who are associated with the organization. Number 4 is people are running what they think is a nonprofit organization, but at the end of the day, it's really a business that's calling itself a nonprofit. Today, there are a lot of popular social enterprises. So one most people know of is something like Tom's Shoes. I think Warby Parker Glasses does this, where they you buy one and they give something away. Many people have the idea that they're going to do this as a nonprofit. That's something called a social enterprise. Pennsylvania does allow for an organization or a business entity, I should say, that's called a benefit corporation or a benefit entity. If what you want to do is just run a business and give stuff away, then you need to start a business. And that's not a nonprofit. Just starting an organization to raise money by, selling a thing or performing a service is not enough to be a charitable organization. So if you are doing things that are basically akin to running a business, you can see the reason that people wouldn't want you to be doing that under the guise of a nonprofit is that it's unfair competition, essentially. If there's a nonprofit car wash across the street from a for-profit car wash, the nonprofit one obviously has myriad advantages. So it's not really fair to the person who is the business owner that there would be a nonprofit competing with it for the same customers, same money, same everything. So if you are running what amounts to a business inside of your nonprofit, that's a very serious legal issue that you need to address. Now, this doesn't mean, many people think that because they're called nonprofits, they aren't allowed to make any kind of a profit. And that's really not true. You can do things that make a profit. For example, a lot of churches rent out space and they get paid for that space. That's fine. You just need to make sure that what you're doing to raise money in these profit-gaining enterprises are not taking over the rest of your organization. So you need to make sure that the charitable portion of your charitable organization is the predominant part, and you also need to be aware that your organization may end up having to be taxed on that income. It's called unrelated business income taxation. So if you really have a burning desire to learn about this, the IRS has a video tutorial that you can watch on, it's called UBIT, or UBI, unrelated business income. So you can learn more about that if your organization does a lot of business generating activities where you try to make money to sponsor the organization, which is more and more common as people look for multiple revenue streams. So the next one, number 5, that I see is people have a mixture of interns, contractors, employees, and volunteers, and that they are not classified correctly. So if you have your employees, contractors, interns, volunteers classified incorrectly, then that can be a very serious legal consequence. Because if you are, it's very common. I see it more and more anymore that people are very keen to hire people, and I say hire sort of in air quotes, hire them as independent contractors. Some places will go even as far as having people set up their own LLC so that they can pay people as an invoice to a business instead of it looking like a paycheck. The reason that people do this is they don't want to pay payroll taxes. Or they don't they don't want to do the hassle of setting somebody up on a payroll system. If that's what's keeping you from having somebody who should be an employee classified as an employee, hire an external payroll processor and just don't worry about it. Then it's out of your hands and you don't have to handle it anymore. But if you have someone who is essentially an employee, if you give them hours, if you tell them how to do their job, if you have them wear a uniform, if you give them a dedicated workspace, or they use your materials or your systems to do the work, then that person's more than likely going to be seen as an employee. So what you're opening yourself up to there is that people will file a complaint sometimes with the state, and they will say that they were incorrectly classified, and then you've really opened yourself up to liability. So do not classify people as contractors just for the ease of having them be contractors. Also buried in that is a lot of people hire people to do fundraising for them as contractors, and they don't check whether they're registered with the state. In Pennsylvania, if you are a professional fundraiser, you do need to be registered with the state. So the next one that I see, I just skipped over interns, I'm sorry. So with interns, the key thing to remember there is that it isn't just free labor. People want to hire an intern so that they can have somebody come in and do work for them for free. That's not what an intern is really supposed to be. An intern is supposed to be someone who is, usually it's a student, but not always, but they're coming in to get experience or on-the-job learning type information, and it's supposed to be similar to what they would get in a vocational program of some kind. They should really be getting some kind of an education. I tell people to think of it as if you had an apprentice. So a lot of people say get an intern and they'll do work for you for free, but really that's not what an intern is supposed to be. In many cases, even the federal and state laws say this, in many cases they can actually hinder you. They can slow you down and make it harder to do your own work. It's not really somebody who's just there to do free labor. So if you classify your interns incorrectly and you aren't paying them, then again, you've opened yourself up to liability through the wage laws. So issue number 6 is letting volunteers get too much power. So this happens sometimes in small organizations where they really need all the help that they can get. So they have somebody, sometimes it's a big donor, sometimes it's one of the founder's friends, something like that. But they get in there and they have way too much power over the organization. So it becomes an issue of managing the volunteer as someone who can be a liability. Sometimes it can turn into an employee claim. Sometimes you have a volunteer who does something like sexual harassment or other issues, and it becomes an issue where you have to manage a volunteer. But oh no, we can't talk to Fred or volunteer about sexual harassment because he's our biggest donor and he does all of our clerical work. And so things start to get very sticky. And so you want to be very careful that you have agreements with your volunteers. I do recommend having a written volunteer policy that describes the limitations of what they're able to do. They shouldn't be, just like interns, they shouldn't be led to believe that a job is dangled in front of them in return for volunteering. So just be very, very careful of not letting volunteers take over your organization to the point where you can't function without them. Issue number 7 is promising donors that their donations are tax deductible. This might not seem like a big deal because a lot of people do it. I've actually seen trucks driving around for certain organizations that have it stenciled on the side that all your donations are tax deductible. The problem here is that everybody's taxes are different. So some people take a standard deduction, some people have maxed out their deductions. People are all different. You don't know their personal finances. So you can tell people that your organization is a 501c3 and that donations are eligible for tax deductions, but you don't ever want to promise someone that they can deduct something because you don't know if that's how things are going to shake out, and you can anger a donor. I've seen it happen. People get very angry and then they aren't going to give to you ever again. Next issue, similar in nature, issue number 8 is not removing the fair market value from the donation that people get when you give them a receipt. So first off, you should be giving receipts. The IRS wants you to do it at $250. I tell people to do it at $200 just to get into the habit of it. Some people do it for any donation. That can be quite a bit of work, but you just need to provide them with some kind of acknowledgement that they've given an amount of money. It's, basically it's a thank you card, but also a receipt that they can use to document that they gave you the money. So the problem with the fair market value issue is, let's say, for example, you have some kind of a gala dinner and you're charging $200 for a ticket to the dinner. But each person, it costs you $50 to have them at the dinner. So you're making a profit, as it were, of $150 off their donation. So they've given you $200. A lot of organizations will give a receipt for $200. That's not what their donation receipt should say. Their donation receipt should say they gave you $200. There was a fair market value of $50 to attend the dinner. And so the difference there is what their actual donation is. So it's $150 is what the actual donation that they did, that they made. So you have to be very careful with that. And there are, again, IRS rules on my blog. If you'd like, I wrote a post about it. But you have to be very careful if you're giving away, they call them premiums or incentives. When people are doing fundraising, you get a tote bag or whatever if you give a certain amount of money. And so you just have to make sure that you're giving people the correct information for what's on your donation receipt. Also because there's penalties. You can be assessed as an organization if you don't do that. Number 9 is that people are unknowingly doing lobbying activity or electioneering. Electioneering is what the IRS calls campaigning for a particular candidate. So if your organization is out there saying, Joe Schmo for Senate, that's electioneering. So you should not be promoting any one individual, any candidate. There are other types of organizations, of other nonprofit organizations, 527, a 501c4. But if you are a C3, you should not be engaging in that activity. It's prohibited. So the other thing that you want to watch is lobbying. And a lot of people think that lobbying is, I think they've seen something on TV where they see people who are very, fancy and chic going to, give lawmakers fancy dinners and tickets to things and whatever. And they have sort of a media-based concept of what lobbying is. But really, lobbying is anything that is intended to bring about some kind of legislative consequence. So if you're telling everybody who's your Facebook follower, let's say, of your organization's Facebook page, if you're telling them all to go and contact Congressperson so-and-so and tell them to vote yes on issue X, you're lobbying. And a lot of people don't really understand that because they see lobbying as I'm going to see an elected official and telling them to do this or that. That's lobbying too, but also these advocacy efforts where you're trying to tell people to do something on behalf of an issue is also lobbying. You can go and talk to people who are lawmakers in your area and just tell them what your organization does. That's fine. You're just introducing them to who you are and what you do. That's not lobbying. That's just saying we exist. That's okay. If you are doing educational activities or if you're doing things that are even-handed, like if you have some sort of a political forum where all of the candidates are allowed to come and talk for 5 minutes, that's probably going to be fine. But if you have one where you only invite the Democratic candidates or you only invite, the candidate that you like to come and speak, that's going to be prohibited under electioneering. And then if you are trying to encourage people to get legislators to take certain actions. Again, that's going to be sort of like a second-hand lobbying, if you will. It's by going through an intermediary. So just be very careful of that. You can do some lobbying. There is no perfect cutoff point. A lot of practitioners say 5% of your activities or your budget or is where you would like to keep that. So if you do that type of activity, try to keep a record of how much time and money you're spending on it. There's an H election that you can make. It's a form you have to fill out where you can be judged on how much money you're spending on lobbying. It makes things a little bit easier to calculate. So if you anticipate that you want to do a fair amount of that, that might be something to look into. But for most folks, I tell people to keep it very minimal. It's supposed to be insubstantial is what the IRS says. And then last thing, item 10, is failing to manage or adequately track or oversee your organization's finances. One problem I see with volunteer boards is that nobody wants to be the treasurer. It's not fun. People are afraid of numbers, they're afraid of finances, and so they don't want to be the treasurer. So it's very difficult to get someone to serve in that capacity. I often recommend to people that you recruit specifically to obtain a treasurer. I used to tell people that if you can balance a checkbook, you can probably track finances for a small organization, but a lot of people tell me I don't know how to balance my checkbook. So I've stopped saying that now. But if you do not have a treasurer, you can actually be violating laws. And little amounts of money. I've seen organizations have tens of thousands of dollars embezzled, $20 at a time. So you really need to keep a track on all transactions going on. The board as a whole should have a big picture concept. They don't need to see every single little transaction on PayPal. The treasurer does, and most likely someone on the board, or someone who's a staff member, if you have staff or employees for your organization, should also be doing that. So if you have an executive director, development director, those types of people should be seeing individual transactions, but the board as a whole can just see big picture information. But you do need to have people keeping track of that kind of thing. If you're bringing in over $300,000 a year, you also need to have an external audit. Again, make sure that there's always checks and balances. A lot of organizations will have a spending limit where above that you have to have 2 signatures. But again, if you're stealing $20 at a time, that doesn't really help. But it is one way of keeping track of things. I don't recommend handing out debit cards freely to people. A lot of people do that in their organization so they don't have to worry about expense reimbursement. But I don't recommend that because it makes it very easy to steal. And it's very sad to say, but the nonprofit community is extremely trusting, and so it does make it very easy to embezzle. And I see it more than I would like. I would like to see it not at all, but I do see it a fair amount. So just in general, that's 10 points that I see a lot in my practice, where it does tend to be the same legal problems that I see in people's organizations over and over and over again. It's, most organizations don't really talk to other organizations as much as they should. So I really wish that people would share resources more, but a lot of people are very siloed. So if you don't know what best practices are, I would really, I know that it's everyone's favorite thing in the world to read IRS regulations and to visit the IRS website. They actually do have a lot of really good tutorials. There's video tutorials and courses that you can take, and you can really educate yourself and help your organization to stay out of trouble that way. There are a bunch of resources in the Pittsburgh area to go to, and just constantly try to keep learning. I have a blog on my website, which I posted. My practice is called Salisbury Legal. So if you would like to check out my website, I have, all of these things have articles, and also, fundraising law, that sort of thing. Areas that trip people up all the time, I try to address. It's usually as I see somebody has a problem, I'll stop and write a blog post on it. So it's, all based on real issues that I see in my practice. It's not just theory or legal concepts. It's really directly applicable to your life. So one thing that I do is, if people have problems with their organization where they aren't really sure if they're doing things correctly or not, and they just want to be reassured, or they want to be told, no, you're not doing this correctly, and here's what you need to do to fix it, I do what I call a wellness check with people, where they come in for 2 hours. I just charge $300 for it. It's really, not that expensive in the grand scheme of things, to make sure that you're doing things correctly. So if in going over any of this list of things, or you have any other things in your own mind where you really aren't sure if your organization is doing what they should be doing, please don't flounder around. You really can find the answers relatively inexpensively, and trust me, it's a lot easier to head them off when they're still small problems than to fix it once it becomes a giant problem later on. So I would much, much rather see people when they have a small problem than when they have a giant one. It's really sad for me when I see people come in and I say, I wish you'd talked to me a year ago. So that's basically what I have to talk about, I see that there's a UBI question that came in. What is that? So it's unrelated business income. So that's just your organization should have a charitable purpose that was registered with the IRS. And so if your charitable purpose is not related to the income generating activity that you're doing, example would be I represent a few cemeteries. So some of these cemeteries used to have caretakers' homes on the property, and caretakers of cemeteries aren't really, on premises jobs anymore. So what a lot of people have done is they try to generate income for the cemetery. Cemeteries are C13, by the way. So they try to generate income for the cemetery by renting out that house. That's fine, you can do that, but you need to keep in mind that the purpose of a cemetery is burying people. It is not running a boarding house or an apartment complex or letting out rooms or any of that type of thing. So that would be an example of something that's most likely going to be seen as unrelated business income. So, if you are an organization dedicated to the awareness of some disease or something like that, and you're running a car wash, and let's say your car wash is wildly successful and makes up an enormous part of your budget, that's going to be an issue of unrelated business income. So you want to be really, really careful that that doesn't start to take over and become more. It's especially problematic if you have that type of stuff that's actually more than the donations that you're bringing in. So you really want to be careful to keep everything in its proper stream of income. It's great to have multiple streams of revenue for your nonprofit because then you're hedging against one of them disappearing one day. But you want to be very, very careful that you don't become over-reliant on one stream of income, especially if it's unrelated business income, because that's very dangerous and you can be eventually seen to be running a business under the guise of nonprofit, which is one of the things that I touched on today. So I'm going to wrap it up because we have somebody else who's going to be coming on. So my time is coming to an end, but thank you very much for the opportunity to talk about that. I hope that was really helpful for people and will help people to avoid making any of those mistakes. Thanks.